What's up, man?
All right.
Finally back in the studio together. It's been years.
It's been a minute. I feel like I'm a guest on the show now.
Yeah, no. Welcome to our show, Jerry. Our guest this week will be Jerry.
Guest this week? Dude, it has been one crazy week after another, but this week is insane on the market.
I know, and I haven't even kept up with the market this week because I've been traveling all week and I'm just relying on you.
Yeah. I don't think this show is going to be too long, but it's going to be kind of interesting, and it gives some people, like a lot of people have been asking for things that I look at during the week, and I'm doing research and all that. Yeah. And this is going to be some of that and some other things.
Cool, man. Let's get into it.
All right. TSP Weekly Update Show, 24 July. Jesus, middle of the summer. 2022. All right. So if you're watching any of the same YouTube stuff that I am, probably anything that I'm not watching, it's all very similar. A lot of people are bullish for the short term, but very, very bearish for the long term. And four of my favorite guys we're going to take a look at kind of real quick. For each one of them: Martin Armstrong, Harry Dent, Lance Roberts, and Tom Bowley.
This is like the good news, bad news thing, right? You want the bad news first, you want the good news?
Yeah. You know, I've actually spent a couple of weeks on and off trying to find people that are bullish.
Yeah.
And I can't find them because I'm trying to make sure that I don't have like a bias, confirmation bias, right? And so I'm trying to find people that can articulate a reason why they think the market's going to go higher from here.
Yeah, there's definitely groupthink out there in the financial industry as a whole, especially like the financial entertainment industry, right? That's what I started calling it.
Yeah.
And it's what it is, right? It's just entertainment on financial news. But it's hard-pressed to find someone that's like, oh, no, we're going to be fine.
Yeah. Actually, you have a good point. I cannot tell you the last time I watched MSNBC.
Yeah.
MSNBC? CNBC. MSNBC
Same.
either.
Same. Either one.
So CNBC, I haven't. I mean, months and months. I just don't watch it. And
I try to balance back and forth between Bloomberg now and Yahoo. Has some pretty good shows, and I'll try to catch either one of those. But even then, at the end of the day, as long as most people realize that they're just trying to fill airtime.
Yeah.
And so they're just going to talk, even when they're not really sure what they're talking about, even if they're experts.
Yeah.
They're just trying to fill airtime. So you have to decipher it. So I try to teach my kids all the time. I'm like, you have to filter, right?
Very true.
Listen to everything and read everything with a filter and go, okay, what's the takeaways from this, right? Yeah. And back to the original point that I just don't see a lot of folks out there saying, oh, everything's going to be great. We're going. They're like, well, it might be great in the short term.
For a minute, yeah.
Yeah, let's get into that.
Yeah, there are some people that think that this low that we had in June is a relatively significant low, and we could have a pretty, decent bounce. And we'll talk about what each of these guys, at least these four guys, think. Then we're going to take a look at Apple again. I know we've done it a couple times, but I'm going to do two different charts for Apple because it sort of exemplifies a lot of the analysis that I do. And then the TSP fund charts. Okay. Put this up last week, and I'm going to keep it up there until I think the kind of the energy comes out of the room. I mean, people are freaking out, and actually at this point, I think there's more people freaking out about the new TSP site. I don't even want to go down that road on this, but holy moly. I mean, I cannot believe the caliber of people that are on that Thrift Retirement Investment Board put out a product like this. I just can't believe it.
Yeah, I kept being the kind of optimist for a while. I was like, they'll figure it out. It's okay. There's always hiccups, right? Right,
sure.
And being kind of a tech geek guy myself, I mean, I do all of our back end stuff, and it's not easy, right? And I'm not an expert at it by any means, but I slept in a Holiday Inn Express, and so I figured it out. And we're having like a few glitches with our app right now. If you have our app, it's not consistent across everybody, so that's always fun, meaning like it's just a handful of people. Right. I'm like, well, it's still an issue, but I got to figure out what it is. So anyway, like I look at that and I think on a grander scale, I'm like, oh, I got to give these guys a break. Not anymore. Like, nah, you should have kind of figured this out by now. This is really unreal. The stuff that we see in our Facebook group of
That's crazy.
what's going wrong. It's not even as simple as like, we shouldn't even go down the road because we're beating a dead horse.
Yeah. Now, the thing that I was talking to a guy this morning, and because these guys that run the FR, I keep getting the acronym wrong, but the board.
It's their savings board.
It's their savings board. They came from Deutsche Bank and, Goldman Sachs. Like, they're like the highest end guys, right? They get appointed by the president, confirmed by the Senate. Like, it is no joke, right? And so they could easily be Larry Fink, for example, who's running BlackRock. Could you imagine if BlackRock or whoever's running Fidelity or Schwab or whatever, they wouldn't it wouldn't even cross they couldn't. They wouldn't put out a product like this. Why? Because if Fidelity did it, it would take an hour. This thing would be up for an hour, and Fidelity would have no more customers. They would all go to Schwab.
Yeah, exactly. We don't have anywhere.
We don't have that.
Nowhere to run, and they know it.
Of course, they know it. They can give us what we get, and we'll like it.
We don't have to make this a political show, but you folks.
I'm trying not to.
But you folks know how to solve this. You get you pound your local congressperson and tell them. And at some point, they'll get sick of the phone calls and emails and texts and all this stuff.
And while you're at it, remind him that his TSP is jacked up too.
Yeah, they're in the same boat we are.
It's unbelievable. All right, sorry. I need to meditate with my girl here. Apparently. Okay. Bullish short term, bearish long term. This is the best I can do. Basically, everybody I follow is so bearish. It's ridiculous. I'm trying really hard. For my own sake, to when the technical indicators cross, and I need to put out a bullish alert, I have to fight the urge of like, oh no, I know I shouldn't do this because I know the market's going to roll over, because everybody's so bearish. You know what I mean? Yeah. So I got to fight that to do the actual analysis that we do, right?
And that's what we love about you is at the end of the day, you're going to make the decision. The data says. I know that about you. You're just going to be like, I can't. But I know you still struggle with it.
Yeah.
Because you're human, right? But you're like, you know what? This is what it says to do, and we have to take emotion out.
That's the whole point. Yeah,
it's the whole point. Yeah. And regardless of what tools or methodology you're using, just got to take emotion out. Now that's easier said than done for sure.
Yeah, it's very hard to do. Okay, so basically everybody, or the best I can find is some. Very smart people are bullish short term, but everybody is bearish for the medium to long term. So Martin Armstrong, pretty controversial figure if you Google him. His website's armstrongeconomics.com. You'd have to Google it. He's got a documentary out there. He's been in trouble with the law. He has a computer program that's called Socrates that apparently the government tried to buy from him and he refused, and that generated this whole big thing that put him in jail for 10 years. And so anyway, he's got this AI thing called Socrates that he uses to create this economic confidence model, and it's got different sectors in it, and it's all based on the flow of money between countries. And so as money flows into the U.S. stock market does well. As money flows out of the U.S. into other countries, it's all relative, right? Because currencies are relative. So that's a big part of what he does is watch the flow of money between countries. His system, right? So he does the same kind of thing I'm doing. He's interpreting what Socrates is telling him. He says he doesn't have his own opinion. He's just interpreting what the data in his models tell him. So he's expecting that we had a pretty important bottom in June and that stocks rally into late August and into September as capital continues to flow from Europe into the U.S., basically because Europe is much worse off in terms of inflation and recession than we are, and war in the Ukraine. Who knows how it's going to end up if anybody in Europe has oil to heat their house over the winter. But he says that, quote, 2023 will be the year from hell. So take it for what it's worth. Take a look at Martin Armstrong and his stuff. One of one of my really good friends, he's my technical analysis coach, basically. He says Martin Armstrong is the only guy he follows. So take it for what it's worth. Harry Dent at harrydent.com. If some of you guys might have heard of him, he's written a ton of books. He's usually bearish. It seems like he's always calling for a major market top. And so a lot of people kind of write him off because of that. His first book is really, really good. And his whole, it's all about demographics, right? His whole original theory is based on demographics. He's not the only one that talks about demographics. It's a huge part of the whole economic cycle. The U.S. has been, the world has been declining in the number of kids that we've been producing since basically baby boomers. And so it causes a lot of economic problems. But his stuff is all based on demographics. It's really good. If you sign up at harrydent.com for his, I think it's a weekly rant. He calls it The Rant. It's on YouTube. Only a few minutes long. It's usually pretty good. He also says that this June bottom was significant. He's looking for the market to run higher, potentially through the end of the year, potentially back up to the prior highs of 4,800. But after that, ultimately, he's been calling for an 80 to 90% drop in the S&P 500. So at the end of the day, he is very, very bearish. But he thinks that for the next couple of months, the way he talks about it on his rant, if you go to his last one this week, along with all these other guys that are bullish in the medium term, in the short term, if the guys that are bullish in the short term are saying, hey, use this as an opportunity to decrease your stock exposure. So if you've been in the stock funds and you've taken this drawdown since the beginning of the year, as the market starts to recover, use that as an opportunity to get out, is what they're saying. It's much more complicated for these guys than it is for us because we just move from the stock funds to the G fund or whatever. These guys are, if you can take losses in some of your stuff and offset taxes by those losses. And
we talk about
all
that all
kinds
the time.
of things. Yeah.
And when you have large portfolios of multiple types of instruments, right?
Yeah.
Real estate, private equity.
Yeah.
That's what these guys are talking about.
Right.
A lot of times, again, they're not talking about retirement accounts, much less TSP.
Right.
So it's always need to keep that in perspective.
Yeah.
But to your point, it's a little less complicated for us because we just kind of reallocate to cash or back in, right? And for them, what they're saying is like, hey, as this kind of goes up, it's coming back down. So use that time to start shifting around your portfolio and putting it in safe places. Right. That's what they're saying.
That's exactly what they're doing. And so most of them are saying, hey, so for us, cash and treasuries basically mean the same thing. Mm-hmm. It's the G fund or the F fund, right? There's only so much that you can do if you're a money manager. You have requirements and restrictions. You think the TSP restrictions are bad. If you're a fund manager, they're the one company texted me today, and like the guys are trying to explain why Titan, guys are trying to explain, why their losses are worse than the baseline. Like they're below the S&P, they're below all these things, and they're baselines. And what they said was they're a 100% long fund, right? Yeah. I mean, if you don't have to be long 100%, I don't know why you would put yourself in that box. Yeah. We actually have the same thing. We are 100% long in TSP. It's just that we can be zero if we want. We can be out in the G fund. Right. That is the difference. But we have no negative. We have no inverse.
Yeah. We don't have to go too far down this road, but we didn't get a chance to talk about that article. Yeah. But if you guys, I actually like what they're doing, Titan.com. Yep. They're giving the average retail investor access to things that a lot of other they're part of this whole democratization of the industry, and I'm all for that. But what's funny is not funny, but they put out a lot of good content like to the people. Like I have an IRA with them because I just want to like interact with them and see. I don't have a lot there, but it allows me to be one of their customers, and so I like the fact that they kind of do like we do. Their chief, their chief investment officer, like puts videos in there and explains, and that's what Jerry's talking about. So I shared it with him, and my gut tells me that they want to do basically what we're talking about, but if they did, all of their industry peeps would be so like, what are you doing? Right?
Yeah.
I know these guys are smart.
Yeah.
And I know that what they'd want to do, but it's what we do here, this methodology is so far outside of the realm for a lot of investment advisors, even though they know it's correct.
Yeah.
It's because it doesn't meet the narrative, right? We talk about that all the time. Jerry's going through the Chartered Market Technician program, and I'm going through the Chartered Financial Analyst program. And I tell him all the time, I'm like, dude, I know why these guys think this way. This is what they're taught.
Yeah.
I'm reading this, 300-page manual, and this is just for, day one test, whatever. It's not even the beginning. And that's the mantra, right? And so we get locked into these narratives that they're like, I know it's not true, but it's just the story that I have to keep perpetuating. And I know that's getting a little philosophical, but it's important that you guys listening to this start to understand that. And when we see this every once in a while, we'll have one of our members that like, I sat down with a financial advisor and they were like, oh no, you should, just do this and leave it there. And they're, they've become educated because that's what we're doing, is trying to educate you. And they're like, nah, bro. The market's
going down. Why do I want to be in it?
I don't want to be in the C fund. I want to be in the G fund, which is where I'm at. Have a nice day. And that's great. I love hearing those stories. But anyway, let's get back to the bearish.
So before I forget to point this out, so Harry Dent is an author. Okay, he's not a money manager. Martin Armstrong is not a money manager. He's an economist. And he's he's got a lot of good info out there, but he's not managing anybody's money. Harry Dent's an author. Lance Roberts is managing people's money.
He's managing money.
Okay.
Yeah. Actually manages money. I like that.
Yeah.
He's not an academic.
Yeah, no, he's not an academic. He's a real guy. This is one of my favorite resources is Wealthion.
Oh, yeah.
Adam Taggart did a great job putting Wealthion together, that YouTube channel. But Lance Roberts he runs this company called Real Investment Advice. So RIA, basically realinvestmentadvice.com. And they are one of the RIA firms that are kind of promoted by Wealthion. So he's the chief investment strategist for RIA Advisors. Of course, he uses both technical and fundamental analysis, right? He does these weekly market recaps, and him and Adam kind of go back and forth, and they talk about what happened for the week, and they go into all kinds of different stuff, and a lot of it's technical and a lot of it's fundamental, and it's a really, really good show once a week. So I would highly recommend you guys checking it out. And again, he actually manages people's money. So he talks about what we were talking about before. Like he has this big portfolio, and he can do whatever he wants. And he watches interest rates, and he watches inflation, and he listens to the Fed, and he does all the things, and he's got all the charts, and he's trying to. Nobody can go in a straight line, right? Mm-hmm. He's trying to balance it so that over time things are going up like that.
Sure, that's what we're all trying to do.
That's what we're all trying to do. Yeah. Now that's much different though than pontificating about. I think interest rates are going to do this, and if interest rates do that, then this should do this, and from an academic perspective, when you have to actually put your money where your mouth is, it changes your whole thing.
Yeah. Well, I think that's one of the reasons why you have grown to have a different outlook, is because you're managing your own money. You're skin in the game, right?
Yeah.
And this most financial advisors, even though they're managing someone else's money, they're managing theirs too.
Oh yeah.
Right? They're their own financial advisor. And so when you got skin in the game, or someone else's skin, you do take it. It's different.
Yeah.
You can pontificate all you want to, but no, I need some real data.
Yeah. So a couple, I don't know, maybe a month ago or so, Lance lives in Houston, and the housing market is, for anybody who's been watching it nationally, obviously housing is local, but the housing market nationally has absolutely peaked and is rolling over, right? And he had talked about, he watches all the things that go into housing, mostly interest rates, right? As your mortgage rate goes up, prices are going to start to come down at some point. It's just the way it works. So they had talked about it on the show for on and off for a couple of months, and then he comes on the show one day and says, "Yep, I put my house up on the market. because basically, he talked about his circumstances. Some of his kids had been going to college, and he was downsizing anyway, and they decided that now is the time, and sold the house in like 5 days.
Mm-hmm.
This was maybe a month ago, so actually it sold, and I don't even know if it closed yet or whatever, but it's right at the absolute peak of the housing market. And he said, we're going to rent for probably 2 to 3 years, and then buy a house at the bottom of the market.
Mm-hmm.
I mean, if that's not putting your money where your mouth is, I don't know what is, right?
Yeah.
So
I'm watching all that myself.
Yeah, no, I know, me too. Okay, so he says the market is very oversold in the short term. So everybody is bearish. Everybody thinks the market's going lower, and when everybody thinks that, there's no fuel to make it go lower. So generally, and there's all kinds of reasons, but at the end of the day, he's like, you know what? We need a rally, a relief rally, so that there's some kind of impetus to initiate the next leg down. So he that's sort of his way of saying that he thinks that this June low could be significant. We could get a move higher from here for a minute. But again, he's using this as an opportunity to decrease his exposure to equities, to stocks. Ultimately, he's much more pro bonds than stocks going forward, and he's looking for a serious recession. And I think everybody else is too. All right. So then there's Tom Boley. Earningsbeats.com. He's the chief market strategist at EarningsBeats. Writes this blog that I look at all the time at stockcharts.com. It's called Trading Places. He does an advisory service, right? He's not a money manager. So he's not an author like, Harry Dent, but he's not a money manager like Lance. He's sort of something in the middle. He is the consummate technical analyst. And literally, he was doing jumping jacks. if you saw him on YouTube, that the low was in. A very significant low was in June. And he had all kinds of technical analysis data to make that call. And he was 100% right. How long that's going to be, who knows? But he was 100% right, and he thinks that we're going to be in it, for a month or two maybe, and then it absolutely collapses from there. But he doesn't really he doesn't really give predictions. He's very technical analysis based, and he pretty much responds to what the charts are doing real time. So doesn't really like to bring out the crystal ball. All right, so hopefully that gives you guys some resources to take a look at, and the overall idea is that the next some period of time, weeks, a month, 2 months, maybe none, maybe it's over, I don't know.
Yeah.
We had a little decent rally here for the past month. I don't know. But that gives you some resources anyway. All right, bonus chart, Apple. Couple things. We've done this before, and there's a couple things I wanted to point out because it basically brings all this stuff together. So this is a 3-year weekly chart of Apple, right? Each vertical tick is 1 week of price, right? We've done Fibonacci extensions before. So here's the low from COVID. If we do use the Fibonacci tool and bring it from the low in COVID up to the top in January, right? The lines, the green lines, get put there by the software in stockcharts.com. So the primary Fibonacci extension retracement levels, right, are 38, 50, 62. So Apple, on a weekly basis, retraced exactly 38%. Okay, got support at that 38% retracement level, and then popped up. Okay, that's number one. So if you were looking for a first target on the downside for Apple, that would have been it, and it held at that level. Second thing about this is Apple is now, as of Thursday, I put this together on Thursday. So as of Thursday, for the week, Apple is above that 20-week moving average line. We talk about that all the time on the show. We're going to talk about it here in a minute on the regular TSP fund charts. But you can see once we Apple got back above that 20-week moving average line after COVID. It kept finding support every time it was testing it. We got a little bit below it here, testing it here, testing it there, until January, I guess February. Apple held up a little bit better than the C fund did, but basically that was the week right there for Apple. It ran up for the following 2 weeks, got back above that 20-week moving average line, but it couldn't get above its prior high, and then rolled over. And so this is the first time that it's been above that 20-week moving average line since March of this year. We also got, on a weekly basis, RSI above 50, and we haven't seen that. We haven't seen it since back here in March, but you can see back here. Once we got back above that 50 line, we got support at 50 all the way along until that breakdown in March. And now we're back above it. So as long as you stay above that 50 line, Apple keeps moving higher. And if Apple keeps moving higher, the C fund keeps moving higher. It's not one for one, but Apple's like 25% of the value of the C fund. So it's a good one to watch. All right, so that's a weekly basis, right? So if we break that down a little bit, this is kind of a long-term, this is the 1 year daily chart of Apple, okay? So now the blue line is the 20-day moving average line instead of the 20-week moving average line. So this is a long-term corrective pattern. It's different looking than the C fund, right? So corrective meaning the market corrects in 3 waves, and it moves in 5 waves. So it moves for five waves, corrects that movement for 3 waves, then moves again in 5 waves. If it's overall moving up, then it moves up for 5 waves, down for 3, up for 5. If it's the other way, it moves down for 5, up for 3, down for 5. Okay, it's patterns within patterns. So this is 1, 2, 3, right? That's A. B. 1, 2, 3. C. Right? So overall, it's an A, B, C corrective pattern. Okay. Then we had, so this is, let's say, a 1. Or actually, it's an A. Overall, it's an A. This is a B. Then we have a 1, 2, 3, 4, 5 for C. So this is called an expanded flat pattern, and it's one of the examples that we had a long time ago. I think the one alert that we did, I'm pretty sure we talked about it on the show, but there was back in like March or April, I think it was. I can't remember. I think it was April. There were 3 possibilities that I put up, and one of them was one of these expanded flat patterns.
Right.
And it didn't play out that way.
Mm-hmm.
But this is an example of it actually playing out. So here we are at C on a daily chart, and we're also 130 was the 38% retracement on the weekly chart. So if you looked at those 2 things, now you're going, okay, I have a lot of reason to believe that the bottom is in here in Apple. So then now that you sort of identified that as a really good place to be, you drill in and do the technical analysis. You draw the trend line. Once you get above that 20-day moving average line here, and RSI gets above 50, you're good to go. The only next thing is you want to see what happens when price comes down and tests that 20-day moving average line again. And what happened? It got support there, and it's off and running. So that's how you do it. That's how you do it if it's an individual stock, if it's a C fund, S fund, I fund, any of it. This is just a really good example of how to apply technical analysis. And, if you were watching Apple, you would have been in it at about 145. So that's it. Okay. TSP fund charts. So it was a big week for TSP, right? For I think we were in the green all the way across the board, up 2.5% for the week on the C fund. But if you've been watching the show, back here for COVID, once we got above that 20-week moving average line, we had support all the way along until January. And then ever since then, we can't seem to get above that 20-week moving average line. We had a big move this week, and we're still not there yet, right? We're also, once we got below 50 on the RSI, until we can get back above 50, it's not that you shouldn't be in the C fund. It's just that we need this line to start turning up, price to be up here and riding above this line, right? Just like it was doing back here. Once that happens, then you can leave. Then you can be buy and hold, right? But until then,
for at least temporarily,
until the trend changes again, which of course it will. So we had a big move this week, and it's been going up in this channel for the last since the June low. So is the bottom in? I don't know. I don't know if the bottom's in, but clearly in the bigger scheme of things, we're still in a downtrend. We're at the top of the downtrend. Whether or not we break through it, we'll see. S fund, same kind of deal. We rode once we got back above 20-week moving average line after COVID. We stayed there until S fund rolled over in November last year, so before the C fund did. But ever since then, can't get back above it. Still can't get back above it. And until it does, we're in the same boat. And we also got RSI well below 50. But we had a 3.9% move this week. So you could look at it and go, woohoo, I funds or S funds, back rocking and rolling. Yeah, but do you understand the context of it? It's all about the context. I fund, almost the same exact thing. You can kind of see at this point, you got a huge gap right here in the I fund at 65. So it dropped from 65 to whatever, 63 and change, I guess. This was a huge gap down right there. And then we got here, and we gapped up and almost filled that gap. So it'll be tough for iFund to get back above 65. If it does, that'll be great. And then at that point, it'll be pretty close to getting back above that 20-week moving average line, and RSI will be above 50, but we're not there yet. F fund was definitely the big winner for the week. This is a good thing to put out. This is a huge candlestick, right? I mean, much bigger than most of the other ones on this chart. And certainly bigger. It was as big as this one, right? On the I fund. But so what I'm saying, what I'm trying to get across is the I fund was up 3.26%, right? And it's got this little candle. The F fund has this monster candle, and it's only up 1.1%. Okay, so the F fund is if you think bonds are going to do well, it's up 1.1% for the week. The G fund is probably going to be around 3% for the year. Okay, right. So if you think bonds are going up, if you can articulate and show why bonds are going up, the F fund is a better place to be than the G fund, because you can at least make more, incrementally more, significantly more than the G, but nothing compared to the stocks. Right.
But it's still upward movement. And we did that in, was it 2018? I always forget.
18 was
18 we used the F fund and ended really well. Yeah. And I like to always go back and point that out to folks that are just like, the F fund, well, why would you even be? I don't know.
Yeah.
But if there's reasons, right? It's rare.
Somebody put that up on Facebook this week. Like, I don't like the I and the F funds. I'm like, wait, look, all these funds are tools. Mm-hmm. There's a different tool for each job. Yeah. Right. When the market conditions are a certain way, the C fund does really well.
That's like saying I really don't like hammers and wrenches.
It is.
I'm a screwdriver guy.
Right.
I'm just a screwdriver guy. So what do you do with that nail? I screw it in. No, it's not going to work, buddy.
It's funny. It is like that.
It's exactly like that. I think of it every time. I'm like, okay, I don't know. Like, you only like baseball bats, but you want to drive a car. Right. You don't like cars.
Yeah.
What are you talking about?
It is. It's interesting. And if you're you're old enough, I know. I mean, you tell the story all the time. The early '90s, the I fund beat the C fund by like 300%.
Yeah.
I mean, it was way outperformed the C fund in the early
Every
90s.
fund has its day.
Yeah.
And you just want to be, with the trend, right?
Now the F fund, I mean, there's a lot going on in here. I mean, a lot. And if you're a subscriber to the site, you definitely want to read the newsletter this weekend because it is one of the longest, most detailed newsletters I think I have ever done.
It's a lot in there.
And there's a lot about the F fund in there too. Anyway, but we're on a weekly basis, we are butting right up against that 20-week moving average line, and we're getting close to that 50 line. So F fund could be a better option if it can get above this line, if the stock funds continue to go down. All right.
Questions.
That is all I got.
That's all you got. That's plenty.
That's a lot, right?
Yeah. Questions. If you have questions, send them to us. Where do you find this? Put them in the comment section. Facebook, YouTube, wherever. If you don't have a comment section where you find this, just send us an email.
Yep.
support@growmytsp.com.
Don't send us any more emails about the app. We know about that.
Yeah, I know. I promise, guys, I'm working on it. We're actually, I can't wait to announce once we get it confirmed, but we're looking at really getting a more robust app, which we've had a lot of people asking for. And it's, it's like everything else. It's just a priority list, right? And now that this one is kind of getting clunky and having issues, we're like, all right, maybe now it's time to kind of switch over. But there's a lot going on that we're trying to add, and we'll get to it. We're really always trying to add value and content, and just more than anything, just what we really want to build. Our purpose has always been to build this place you can come to and learn. And learn at any point where you come in. So maybe you come in and you know nothing. You come in and you've been kind of doing it for all of that. And so, it's taken us a while to build that, but it's only been a couple years. Yeah. We're going to keep working at it. Yeah. So stay tuned for more information. Yes, we're working on the app. Website works just fine, except when you guys try to crash it.
Right. And unfortunately, we cannot fix the TSP stuff. The TSP.
Oh yeah, we're not talking about TSP.gov, by the way. Yeah, sometimes people get a little confused, and we're like, we don't run that one.
Yeah, no.
GrowMyTSP.com.
Well, I say thank God. If we ran that one, it'd probably be a lot better.
Oh, I don't know, man. Anyway, I don't want that job. All right, guys, if you have any questions, just send them to us. If you like the show, please share it with your friends. If you don't, share it with your friends.
Yeah. All right.
See you guys later. We're out of here, I think. It's been a while since I've been in the studio, bro.